Let's talk about variable life insurance for a minute. You know, in the last decade, if you were an investor in variable life insurance, the chances are you were probably investing in the stock market. And unless you were very lucky, and I'm going to say it's luck because we don't believe in market timing, nobody's ever been able to really be successful over the decades in market timing. So chances are you probably didn't do very well. However, in the 90s, if you were an investor in variable life insurance, you did extremely well. It was probably the best investment in terms of permanent life insurance that you could have made. So the returns in variable life insurance is really going to depend and vary based upon market conditions and the allocation that you take inside those policies. Certainly there are fees, premium tax fees and loan fees and life insurance costs that can go up every single year, unlike the whole life insurance that has guarantees embedded into it. So the variable life policy, if you're optimistic about the economy long term, if you're putting money in on a monthly basis or a yearly basis over a long period of time, maybe very likely if you have a high risk tolerance that a variable life would be suitable for you. If you do have a variable life policy, then you likely want to make sure that you have other safer assets in another place for diversification, because most variable life policies, to overcome the fees that are associated, need to be making 8–10% return net to be able to make it worthwhile. The idea with most variable life policies is that you're going to be a little more aggressive and get market-like returns, stock market-like returns, and be able to use the cash value or increase the death benefit as a result. You're self-directing the investment, as opposed to a whole life insurance policy where the insurance company is directing the investment, and when they direct that investment, they're putting it into much safer assets. So variable life insurance may be for you if you have a much higher risk tolerance and you're willing to invest over the long term, and preferably if you're putting money in consistently over time and doing what we call dollar cost averaging.